Somewhere in your last few months is a $700 purchase you've already forgotten. That's how little $700 feels. But what if that exact one-time $700 put somewhere else could turn into a $200,000 portfolio that pays over $2,500 a month for retirement? In this video, that's exactly what Josh does. And if you've never done this before, you're not even sure what a dividend is yet, that's fine. That's who this is for. We'll start from the beginning. Then how reinvesting those dividends turns a small income into a snowball. How Josh's 5 stocks got picked. And the honest question, is buying individual stocks even a smart move when you're starting out? And by the end, I'll show you how Josh's portfolio turns a one-time $700 into a $200,000 portfolio that pays over $2,500 a month. Plus a bonus section on how adding just $1 a day grows into nearly $880,000, paying over $10,000 a month. But none of those numbers mean anything if you don't understand the thing making them. So let's start at the bottom. What's a dividend? Here's the plainest version I can give you. When you buy a share of a company, you own a tiny piece of it. A real piece. So when that company makes a profit, some of it is technically yours. Now the company has 2 choices with that profit. It can pour the money back into itself, open new locations, build new products, grow bigger. Or it can take a slice and hand it straight back to the people who own it. That handed back slice is the dividend. You don't sell anything. You hold the share, and the money shows up. Let's put real numbers on it, because that's where it's easy to understand. Say a share costs $100 and it pays a 4% dividend. That means you get $4 a year just for holding it. Buy 10 shares, so $1,000 in, and that's $40 landing in your account without you lifting a finger. Josh looks at the $40 and does the math anyone would. $40 on $1,000 for a whole year. That's not wealth. Maybe a nice dinner, but not something that helps with your monthly expenses. And he's right. But Josh is about to do the one thing that changes what that $40 is worth. Here's the move. Instead of taking that $40 and spending it, Josh feeds it right back in, buys more shares with it. Let me show you what it does. To keep it easy to follow, let's pretend the share price stays at $100 the whole time. So that $40 dividend buys 0.4 more shares. Josh started with 10 shares, now he's got 10.4. Watch what that does to next year. The dividend gets paid on 10.4 shares now, not 10. So it's not $40 anymore, it's $41.60. That buys another slice and would be sitting at 10.8 shares. Year 3, the payout reaches $43.26. Year 4, it's up near $45. And Josh hasn't added a single dollar of his own. The money climbs on its own because every dividend buys more shares that pay their own dividends. That's the snowball. $40, then $41.60, then $43.26, then $45. Each year's payout is bigger because last year's payout bought more shares. And I'll be honest, over 4 years, this looks like a crawl. But look at the jumps. The first raise is $1.60, the next one's $1.66, then the one after that, $1.74. Every year's raise beats the year before because there's more money working each time. That's the crawl that turns into the engine once you give it more years instead of 4. Here's the part that makes the real portfolio pull away ahead of this little example. I froze the share price at $100 to keep it simple. In real life, it doesn't freeze. The price climbs, and the company raises the dividend on top of that. So Josh has 3 things stacking at once. More shares, worth more each, paying a bigger dividend per share. That's why the actual numbers get as big as they do. But a snowball is only as good as what you pack it with. Feed this engine a company that stops paying, or slowly dies, and the whole thing stalls. So how does Josh figure out what's worth putting in? Turns out, he doesn't need a finance degree for this. He needs 3 questions. First one, is the dividend actually real? Some stocks offer a huge yield because the share price has been falling, which makes the payout look bigger than it is. That's a trap, not a gift. Josh wants a yield that's high because the company's strong, not because it's sinking. Second, has the dividend actually grown? One good year proves nothing. Anyone can pay well once. Josh is looking for companies that have raised their payout year after year after year. Third, is the share price going anywhere? A stock can pay you nicely and still bleed value underneath it. Josh wants both. Income that shows up and a price that climbs while it does. Real yield, a growing dividend, a price that's alive. Run every candidate through those 3, and most get knocked out fast. 5 names make it through, and here's what Josh notices right away. 4 of them aren't funds at all. They're individual companies, which is exactly when a smart beginner should feel a little knot in their stomach. Because you've heard the advice. Everybody gives beginners the same one. Don't pick individual stocks. Buy a fund. Spread your money across hundreds of companies. Sleep easy at night. And that advice is good. Let's be honest about why. When you own one company, everything rides on that one company. It has a bad year, you feel all of it. Own 5 instead of 500, and each name is carrying real weight on its own. That's a genuine risk. Pretending it wasn't there would be lying to you. So why do these 5 earn it? 2 reasons. 1, every single one cleared the 3-part screen. These aren't lottery tickets. They're businesses with real profits and long payout histories. 2, they're spread across completely different sectors. A dividend fund, warehouses, luxury perfume, farm lending, local TV. When one industry has a rough year, the others usually aren't in the same boat. But here's the honest line. If the idea of owning individual companies keeps you up at night, that's a real answer, and it means this isn't your portfolio. You could buy that first name, I'm about to show you in a minute, all by itself. Own 100 dividend stocks in one move. No shame in that at all. For a lot of people, it's the smarter call. This video is just showing you what the more hands-on versions look like. So, risk on the table, nothing hidden. Next, I'll show you the 5 stocks that made it to Josh's list. After that, I'll show you how this portfolio is projected to turn $700 into a $200,000 portfolio that pays over $2,500 a month. And in the end, I'll show you how $1 a day supercharges that portfolio, reaching over $880,000 and paying over $10,000 a month. But first, let's look at the 5 stocks. Let's start with the safe one. Schwab US Dividend Equity ETF, with ticker SCHD, is the anchor. And it's the one that isn't a single company at all. It's a fund. Buy one share and you own a slice of 100 different dividend-paying companies. And these aren't random names. The fund has its own filters. To get into this fund, a company has to prove it's paid and grown its dividend for years. A decade-long track record before it even qualifies. The junk gets filtered out before Josh ever sees it. It's been running since 2011, and across that stretch, it's returned about 13% a year, with dividends reinvested. Steady, boring even, which is the entire point. The numbers sit right in the reliable middle. A 3.23% dividend yield, dividend growth of about 10.24% a year over the past decade, and share price appreciation on average around 8.65% each year. Nothing flashy about any of it. It's the foundation the other 4 get to build on top of. Now, REXR, known as Rexford Industrial Realty. You've walked past this business 100 times without knowing it. It owns warehouses. Specifically, warehouses jammed into Southern California in crowded corners near LA, where there's basically no empty land left to build on. The last part is the whole story. When nobody can build new warehouses, The ones that already exist get more valuable. And the rent climbs. Rexford owns 414 of them, around 50 million square feet. Every package that lands on a doorstep in LA passed through a building like theirs, because it's a real estate company. And by law, it is required to hand most of its taxable income back to shareholders. That's why it pays 5.10% yield, the highest in the group, with a dividend that grows around 12.35% a year. Where it gives a little back is price growth, only around 4.69% annually, slower than the rest. That's the trade with REXR. You take the fatter income and give up some of the climb. Third on the list is IPAR, known as Interparfums. It's a perfume company on a dividend list. Stay with me because how it makes money is the interesting part. Interparfums doesn't own the famous names on the bottles. It rents them. It signs long deals with multiple brands like Coach, Jimmy Choo, and Mont Blanc. The Guest deal runs all the way out to 2048, and then makes and sells the fragrances under those names. Low overhead, steady money, brands that were already famous before they walked in the door. Its yield is the smallest here at 2.68%, so income isn't the pitch. Growth is. The dividend has climbed about 19.47% a year, and the share price has appreciated around 15.37% annually. This is the one you hold for what it becomes, not what it hands you today. Here's a company you've almost certainly never heard of. AGM, known as the Federal Agriculture Mortgage Corporation, or Farmer Mac. Ever wonder who lends money to American farmers? Somebody has to finance the land, the equipment, the whole operation. Farmer Mac is a big part of that machine. A government-chartered company built to keep cash flowing to farms and rural America. And it has been a dividend machine. It's raised its payout 14 years running, while still handing out only about a third of its earnings, which leaves plenty of room to keep raising. The full picture: a 3.16% yield, dividend growth of about 22.13% a year, and price appreciation near 18.52%. Add those up, and it's the most balanced grower of the five. Real income, fast increases, and a share price that's genuinely moved. And for the last spot, Josh has NXST, known as Nexstar Media Group, which closes the group on the fastest growing dividend of the bunch. You know your local news channel? Nexstar probably owns it. It's the largest owner of local TV stations in the country, more than 200 stations reaching 220 million people, plus a piece of the CW. And every couple of years, when election session hits, political ad money pours into those local stations like a tide. That cash machine funds a serious dividend. It pays a 4.27% yield, second only to Rexford, and its dividend has grown faster than anything else in this portfolio, about 24.8% a year over the decade, with price appreciation around 12.65%. It's the closer, solid income now, and a payout climbing faster than any other name in the five. So the next step is turning 5 separate stocks into one number Josh can actually use. Start with the yield. Equal weight just means Josh put the same amount into each. A fifth of the $700. That's $140 in every name. And when every slice is the same size, the portfolio's yield is just the average of the 5. So you add them up. 3.23 plus 5.10 plus 2.68 plus 3.16 plus 4.27. That comes out to 18.44. Divide by 5, and you land at 3.69%. That's the whole portfolio's yield. And you'd run the exact same math for the other two numbers. Add up the 5 dividend growth rates, divide by 5, and it comes out to 17.65%. Do it once more for the share price appreciation, and that one lands at 11.98%. So that's the portfolio. A 3.69% yield, a payout growing 17.65% a year, price climbing 11.98%. On their own, 3 numbers on a screen. Now let's see what these numbers turn a one-time $700 into. Josh invests $700 in this portfolio and leaves it alone. Year 1, the account would sit around $810, and the dividends for the whole year would come to just $26. $26. That is the part that feels broken. By year 10, the projections show it reaching $3,297, paying $169 for the year. And I'll be straight with you, this is exactly where most people would quit. A decade in, $3,000 in the account, $169 of income. It would feel like nothing's happening, like it didn't work. It's working. You just can't see it yet because the snowball's still small. Then the back half takes over. By year 20, the account would reach $20,907, paying off $1,797 in dividends that year alone. The income by itself would be more than double the entire $700 he started with in a single year. And in the final stretch, the line would go nearly vertical. By year 30, the portfolio would sit at $217,737, paying out $30,579 in dividends for the year. That's $2,548 a month. Now, Josh wants to know, what if he also adds $1 from the very first day to this portfolio? That's the change. Half the price of a coffee, dropped into the same 5 stocks every single day. $365 a year. That's it. Watch what it does. Same $700 start, same 5 companies, same 30 years. Except now, Josh is adding $1 a day the whole way through. So let's walk the same years again and see where they land. By year 1, the portfolio value is projected to be $1,175, with $26 in dividend income for the year. Right next to the other version, it's slightly ahead. By year 10, the portfolio value is projected at $11,531, with $573 in dividend income. Remember where the no contribution version was at year 10? $3,297. Same decade, same stocks. $1 a day, and it's already more than triple. The gap just keeps widening from there. By year 20, the account would reach $83,045, paying around $7,108 in annual dividends. And by year 30, the projections showing it landing at $876,608, paying out $123,341 in dividends for the year. That's $10,278 a month. This is what a supercharged portfolio looks like. Same stocks. The only difference between $218,000 and $878,000 was a single dollar a day. And if single stocks still aren't your thing, one ETF turns $35,000 into $1.3 million, paying over $5,500 a month. That's on screen right now.